Welcome to the Deep Dive. Today we're embarking on a really fascinating journey. We want to get incredibly well informed about a dynamic market, but, without getting lost in all the noise.
Right.
We've actually got our hands on a comprehensive market update and a really curated list of commercial investment opportunities. It's straight from the Eureka Business Group, dated July 26, 2025.
Pretty current stuff then.
Exactly.
Yeah.
And our mission for this deep dive is, it's to pull out the most important nuggets about what's happening right now in the Texas commercial real estate scene, and also to spotlight the specific kinds of opportunities that experts in the field are actually putting forward. So this isn't just general trends.
No, definitely not.
It's about diving into what's really on the table and understanding the thinking behind it.
And that's exactly why looking at specific, curated listings and direct market commentary like this source we have is so powerful. It gives you a granular understanding, something you just can't get from skimming, say, general economic headlines.
Mm-hmm.
This kind of detailed analysis, I think, is really key to being truly well-informed. It lets you see patterns, maybe opportunities that might otherwise just be, invisible in the broader economic story.
Okay, so let's get into it. The Eureka Business Group, they kick out their update with a really strong statement about the Texas economy. Basically, it's still pushing forward.
Yeah, they seem quite bullish there.
They do. They highlight that over 20% of all international investments in the USA were directed right into the Texas economy. And interestingly, despite what they actually call the apocalyptic conversation in the media about tariffs, consumers are apparently still spending.
Huh. That's interesting. It pushes back a bit on the common narrative. And what's fascinating here is how they directly address all this persistent talk of a recession. Their response isn't really a flat denial. It's more practical, almost a counter-cyclical view.
How so?
Well, they say in uncertain times, they believe the best way to build and preserve wealth is through NNN investments, specifically ones with strong tenants and longer leases. They even have this catchphrase for it, NNN in TTR.
TTR.
Which stands for transfer the risk.
Transfer the risk. I like that.
Yeah.
It's a clear principle. And I guess this brings us right into their handpicked list of top opportunities then.
Seems like it.
It looks like they've really sifted through, all the commercial listings that came on the market to kind of distill what they see as the best value. But why is this NNN strategy so dominant in what they're recommending?
Well, it's a very shrewd approach, I think, especially in the current economic climate. NNN, or triple net, leases basically mean the tenant is responsible for property taxes, insurance, and maintenance.
Okay, so the big three operating costs.
Exactly. This significantly reduces the landlord's responsibilities, and crucially, it kind of insulates the investor from rising operational costs, maybe inflation too. It's really about predictability and stability. You're effectively transferring those direct financial pressures of owning the property onto the tenant. It aligns perfectly with their transfer the risk mantra.
That makes perfect sense. So, okay, looking at some of these specific opportunities they list, a clear pattern does emerge pretty quickly. A lot of them involve these highly visible, high-traffic retail centers, often fully leased and frequently with national tenants.
Right, the big names.
For example, they feature a, 5,942 square foot retail center, national tenants, yes. And it's located in a massive 430,000 square foot power center. And get this, it sees 4.7 million annual visits. Plus, here's a standout figure, 169,000 vehicles per day on I-635. That's serious exposure.
It really is. And see, this isn't just about traffic volume in general. It's about consistent customer flow. And that means built-in demand for the tenants, which, translates directly to stable income for the investor. That's the goal.
Right. Income stability.
And there's another example highlighting this. 3,005 square foot single tenant property. They explicitly state 0 landlord responsibilities.
Here's that NNN again.
Definitely. And over 14 years remaining on the lease. So long term, again, that NNN structure is key. And it's coupled with high traffic counts, over 40,000 VPD vehicles per day.
Which is critical for retail visibility, like you said.
Absolutely critical.
So this focus on high traffic and national tenants is clearly a cornerstone strategy here.
Yeah.
But then we hit one that it made me pause. It seems like a unique asset. It's a roughly 12,848 square foot single tenant property located in the Austin MSA.
Okay, Austin area.
Right, metropolitan statistical area for Austin. Now, what caught my eye immediately with this one, the sale apparently includes $1 million of arcade equipment.
Wow, okay. That's different.
And it boasts an 8.02% cap rate.
That's quite strong. An 8% cap rate is definitely attractive. And that property, it is unique. The cap rate or capitalization rate, that's essentially your unlevered rate of return on the property. It shows how profitable it is relative to the purchase price.
So 8.02% is good.
Yes, quite good in many markets. And this particular listing, it raises an interesting point, doesn't it? Beyond the usual metrics like traffic and lease terms, what unique assets or maybe income streams might be bundled with a commercial property? That arcade equipment is a perfect, if unusual, example of a non-traditional value add.
True.
They also feature another one, a 9,631 square foot single tenant property. This one's anchored by a huge 330,000 square foot Target center. That center sees 3.3 million visits per year. Also, it has over 110,000 vehicles per day on Highway 114. And crucially, this one has a corporate guarantee.
Okay, corporate guarantee, that sounds like a really significant layer of security for an investor. What does that mean specifically in this context?
It means that the tenant's parent corporation, the big company, is backing the lease, not just the individual store or franchisee that might be operating there. This adds a much, much higher level of financial security. The obligation to pay rent falls on a larger, usually more stable corporate entity with, deeper pockets. It significantly mitigates the risk of the tenant defaulting on the lease, which makes it a highly desirable feature, especially for these long-term NNN leases.
Got it. That makes a big difference. Okay, shifting gears just slightly, but still kind of in the growth vein. They also list a 6-acre unrestricted land parcel. It's got US 380 frontage located in the McKinney ETJ.
McKinney ETJ extraterritorial jurisdiction.
Right, that area just outside the official city limits where McKinney has some development control. They call this location DFW's hottest growth path. Now, this seems like a very different kind of opportunity, right? More forward-looking for development rather than immediate income like the retail centers.
Absolutely. That's a different play entirely. This kind of unrestricted land, especially in a known high-growth corridor, offers immense flexibility for future development. It's likely attractive to certain types of investors, maybe developers, people looking for long-term capital appreciation rather than that immediate cash flow from rent. It shows a different kind of market vision from Eureka.
That's a key distinction. And then, okay, we're back to retail centers, but maybe with a similar future-focused angle. This one's a 12,124 square foot retail center. It's in a growing community, built just last year, 2024, and it's surrounded by plans for over 6,000 new homes. That really signals a focus on anticipating future population density, right? Getting in ahead of the curve for a sustained customer base. Smart.
That's a great observation, yes. It's absolutely about anticipating where the population growth is heading and investing before everyone else gets there, investing ahead of the curve. They also list another one, a 26,050 square foot retail center. This one's 92% leased, has a 7.1% cap rate, and it's in an area with over $120,000 household income.
Wow, high income.
High income and high occupancy are always strong indicators of a healthy, stable market for that kind of retail.
Makes sense. And there's another retail center, 14,625 square feet. This one's 100% leased. It's in a high residential growth corridor up in Anna, Texas. And they specifically mention long-term leases and staggered expirations. Staggered expirations are smart, aren't they?
Oh, definitely.
It mitigates that risk of all your leases coming due at the same time, which could lead to a huge vacancy problem all at once.
Precisely. That strategy gives you much more consistent cash flow over time. It helps avoid those large vacancy risks that could otherwise really disrupt an investor's income stream. Very prudent. Then, moving into their sort of higher price bracket, the $5 million to $10 million category, they highlight a 10,866 square foot childcare facility. It's got a corporate NNN lease, 12 years remaining, and importantly, annual rent escalations built in.
Built-in growth.
Yes. So again, you see the NNN lease structure and that consistent rent growth being emphasized. Stability and predictability.
And in that same price bracket, there's a 10,655 square foot retail center. Also 100% leased, also with long-term NNN leases and staggered expirations. This one's located in an affluent, fast-growing Houston suburb. It really seems like this consistent focus on NNN leases across different property types, retail, childcare, it really underlines that transfer the risk strategy they mentioned right at the beginning.
Absolutely.
It's clearly not just a catchphrase for them. It seems to be a core guiding principle for the opportunities they've curated here. really aiming for stability amidst these broader economic uncertainties we keep hearing about.
I agree. It shows Eureka's conviction that in a market that might be grappling with inflation, maybe higher interest rates, that de-risking the operational side of real estate is absolutely paramount for their investors.
Okay, so while that NN model clearly dominates Eureka's income-producing recommendations, they also showcase these opportunities that hint at a different kind of long-term play, often involving significant development potential, like that land parcel we discussed. And this takes us to a really multifaceted offering down in Cedar Hill, the Cedar Hill ISD asset sale. ISD being Independent School District. This seems like a completely different beast altogether. It's described as a full package including commercial land, residential land, a warehouse, even a school building, and mixed-use land.
Wow, okay. A whole portfolio from the school district.
Exactly. They list 7 specific parcels within this package, including land that's zoned SF10, which I believe is single-family residential.
Yes, typically larger lots for single-family homes.
And large-built properties, like one at 912 Cedar Street, that's over 109,000 square feet. It's zoned OTSQ.
OTSQ, Old Town Square zoning. That often implies mixed use or specific commercial uses designed for a town center feel.
And the description says it's in the heart of Cedar Hill future growth path. Very explicit about the location's potential.
This bundle of assets, it really showcases the diversity of opportunities available beyond just traditional retail income streams. It looks like it's about leveraging maybe municipal asset divestment, the school districts selling off surplus property and positioning strategically for those future growth corridors they mentioned.
Right.
This type of offering, it probably appeals to a very different kind of investor profile, likely those with development expertise or maybe entities looking for large-scale, long-term plays in areas specifically designated for significant future growth. It really demonstrates that commercial investment opportunities truly span a wide spectrum. It's not just one thing. It goes from stable, income-producing NNN leases all the way to raw land with significant development upside.
Okay, so if we step back and sort of synthesize all this, what are the key insights we've gained from this deep dive into the Eureka Business Group's material? Well, first, it seems pretty clear there's an apparent resilience, maybe even vibrancy, in the Texas commercial real estate market, right?
Right.
Especially with that mention of international investment flowing in.
Despite the broader anxieties.
Exactly, even in the face of those anxieties. Second, we've definitely seen a strong, very deliberate emphasis on specific investment strategies, like these NNN leases, presented almost as a direct response to current market conditions, really focusing on stability and mitigating risk that transfer the risk idea.
Yeah, a very clear theme.
And third, just the fascinating variety of the opportunities currently available is noteworthy. It goes from those fully leased retail centers we talked about to massive land parcels ready for development and even unique assets like that property with the arcade equipment. It shows a really multifaceted approach to investment in this space.
Yeah, and if we connect this to the bigger picture, I think even a deep dive into specific listings and market commentary, just like this one, provides really valuable insights into broader economic resilience, maybe specific local growth patterns, and certainly the diverse ways people are approaching commercial real estate right now. It encourages, I think, critical thinking about how these very localized, sort of granular insights, which reveal the precise strategies experts are actually using on the ground, can inform a larger understanding of market dynamics, regardless of the general headlines you might be hearing day to day.
That's a great point. So maybe a final thought for you, the listener, building on this source material. What might these specific real estate opportunities and the overall sentiment we're seeing in Texas tell you about the future of local economies and maybe niche markets more broadly? And perhaps more importantly, how can you apply this kind of granular, source-based analysis to whatever field you're curious about next? Thank you for joining us on this deep dive. Keep that curiosity alive and keep exploring.